All right. So, hello everyone, and welcome to Philosophy Culture. I'm here as always with my big bro Emil's podcast, bro. What's up, man?
I'm good, man. Podcast, bro. What's up?
I'm good. I'm good as well. Excited for this episode actually, where we will talk about banks.
Banks. Me and Constant will talk about banks and the ways banks make money. So that's basically it. Yeah, and then we will mention something about treasury bonds and banks. Check it
All right.
out.
Check it out.
All right, banks.
Banks.
What are they doing, man?
Banks. That's a good question, right?
Yeah, we should talk about it.
Yeah. As we discussed last episode.
Exactly.
But good. So why talk about banks? Why?
Because
Why?
we are giving our money to them, man.
Okay.
And we should know how it works. We
Okay.
should know how it works.
Yeah.
Yeah, that's my answer for today, man. What do you think?
No, I mean, I just think that they are such an important part of the economy.
Yeah.
They are such a important institution. So yeah, institution. Yeah, they are just a very important part in the economy and in a country, or in the countries. So yeah, they are actually worth an episode, aren't they?
For sure. For sure.
And especially since we are talking about investing and money and so on. So yeah,
Exactly.
yeah, good.
All right. So where should we begin?
Would you like to start with your Hermosi episode? Because before starting this recording, you were just about to say something about it.
Right. So just for context, when we were kind of getting ready for this episode, I was on YouTube and I saw this clip of Alex Hormozy, and he was talking about the exact same topic that me and Costin would do, yeah, this podcast about, right? About banks. And he kind of summarized it, yeah, quite shortly, and yeah, basically what he said is that it was kind of, I don't know, a short information about what we are going to talk about today, basically. But uh, yeah, so what he was saying is when you put your money in your bank account, you're basically loaning your money to the bank, and the two things you want to know when you are loaning somebody your money is how likely is it that you will get your money back, and how much will I get paid in interest rate. And then he went on by saying that people are like, so confident that they will get their money back, but that historically speaking, that isn't always the case. And his way of combating that risk, I guess, is by he was kind of presenting that you could put your money in treasury bonds instead, because when you have your money in your bank account, you like in your like typical checking, what you call it, checkings account.
Yeah. Yeah.
I think that's the term for it. But yeah, you don't really get that much interest on your money. And yeah, we will get into that more later on. But yeah, and what he was saying, that if you put your money into treasury bonds, you will typically get like 4% in interest. I guess that also depends on what kind of bonds, which we will also speak about more, I guess. Yeah, that's basically like what he said. Uh, yeah, yeah, yeah.
Hmm. Yeah.
Comments, constant.
Comments. That's interesting because last episode we talked about, or we talked about, last episode was based on an podcast by uh,
Rob Moore.
Rob Moore, thank you.
Yeah,
And there he said that he would not buy bonds because uh, the US government is in such a huge debt. And why would you basically borrow money to somebody that is not able to pay back the money? And especially since they are just sort of putting that threshold or that limit up like higher and higher. Because I
right.
think they have surpassed that limit of how much they could be in debt. I don't know how many times, and they just keep sort of uh,
Like
yeah, yeah,
raising the
raising it. Yeah.
right.
Um, so that yeah, that's interesting. On the
It
other hand, yeah, on the other hand, I've heard that bonds they could work as a hedge against inflation, just as uh, gold. That is to just preserve the value of your money. Um, so yeah, I think obviously, as everything on this earth, there will be mixed feelings and thoughts about a particular thing. But yeah,
and yeah, and that is why that is so interesting, like to speak about the economics and investing and stuff, because I once listened to this Jordan Peterson episode when he like spoke to a some economic financial guy, I don't know, but he basically said that um, people argue like what's the best way, and you should invest in gold, no, you should pick stocks and or whatever. But the thing is that there are countless ways almost that you could build your way build countless ways to build the wealth, or to get
yeah,
rich. So yeah,
I think there are so many recipes to that, and it's really really hard to actually say that yeah, okay, this is the correct one, or you should go this way. Because I think that every person, as we have seen, I mean, we have done some podcasts on different persons and founders uh, before, and everyone had their way and their path in their life. So it's really difficult to actually claim that there is a perfect way to do it.
yeah, 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 for
Uh,
sure, for sure. But it was interesting that what you said, that these treasury bonds can work as a hedge towards inflation, inflation. But yeah, and why that is interesting is because Hormozy also said in the short that if you buy treasury bonds, you are basically guaranteed that you will get your money back since they can always print it, you know. So I guess that is why it could work towards inflation. Like yeah, like against work as a what you call it,
hedge.
a hedge. Yeah,
I think the hedge would be that it keeps its worth despite the inflation, in the sense that if you borrow your money to the government and you buy that specific bond, you will get an interest on it, right? So you
yeah,
will get some money, some additional money besides your money that you borrow. And I think that if the interest rate is higher than the actual inflation percentage, then it means that in the end, you will get your money back and it will have kept its value. And if you also have some luck or if you're doing it strategically, you will also get some extra money.
Yeah,
Uh,
yeah, yeah.
and I don't know, I think I saw a video where they mentioned that the average inflation rate in the US was like 2.55% per year.
Hmm.
Um, I'm not 100% sure on that. So
Yeah.
no more comments on that because
No more
I'm not
comments.
the inflation rate professional, but yeah.
Not yet, not yet.
Uh,
Uh,
yeah.
but yeah, okay. So treasury bonds, yeah. So basically, what that is that we lend our money to the government, right? As you said before the podcast. Just
Yeah.
to, I don't know, to make it clear, maybe to somebody who isn't uh, that knowledgeable about that yet as me.
No,
So
no.
to yeah, keep it simple.
Yeah, and then the question may rise that why are we actually borrowing the government money? And that could just be, for certain projects, or I don't know, if they want to build a bridge and they want to raise some capital, then they just, sell some bonds,
Right, right, right.
just as a very basic example.
Interesting, interesting, interesting. And should we go through the different type of bonds as well?
Yeah, I think you're the professional on that.
Yeah, I have some notes on it.
Yeah.
Yeah.
So sure, why not?
So, all right. So, I will just keep it short with the word treasury. I will just say T instead, because that is how I have actually written it in my note. But yeah, so we have T bonds, so treasury bonds. We have T notes, treasury notes, and T bills, treasury bills. And bonds are the longest form of bonds, I guess, or that they mature in the longest period of time. So they mature in like 20 or 30 years and offer the highest coupons, whatever that means, or interest, which are paid twice yearly. Then we have T notes, treasury notes, and they mature from 2 years to, or yeah, from 2 years to 10 years, with a semi-annual interest payment, usually lower yields than T bonds. So yeah, they aren't as profitable, I guess, as treasury bonds, right? Then we have treasury bills, T bills, and they have the shortest period before maturity, and that lasts like from like 4 weeks up to a year, basically. So
4 weeks.
yeah, from
Yeah,
4 weeks to a year,
that's interesting.
and I guess they have the lowest yield, would my
Yeah.
guess be. But then also, I think that I would like to bring up, like regarding to bonds, is that in this short of Hormozy, I read the comments just to like check what people are saying. Then there was this argument that like argument also against bonds. So even like we have this argument by Rob Moore that you like that governments can't really be trusted since they are in so much debt, and yeah, so on. But also a argument against the bonds is that they aren't as liquid as a bank account, and that basically means that you can't as easily convert or like get your money back, I guess, because from my bank account you can easily just what you call it, withdraw money. So yeah, yeah.
Hmm. That's a good point. Yeah. And that's really true as well. Um, because in the case of bonds, you would be tied by that period of time you actually borrow it for.
Yeah, yeah, yeah.
Yeah,
Exactly.
that's a good point. Yeah.
Exactement.
Yeah. And then I was thinking about, the bonds and the banks. Do you remember? I think yeah, last episode I said something about
Mhm.
bonds and that banks are forced to buy them
Exactly, yeah.
from the government. Yeah. Do you have some notes on that?
Nope.
No, yeah, I tried to sort of make I basically try to understand it somehow, and if I conclude it very shortly, and I hope my conclusion is correct, is that so the government would issue some bonds, and these bonds are bought by the Federal Reserve, so the central bank,
Right.
and then the the Federal Reserve, the central bank would use these bonds to actually stimulate the economy in the sense that increasing or decreasing the money supply, and hence also impacting the interest rates and the inflation. So the thing is that the Federal Reserve would buy bonds from the government, and in order to increase the money supply, they would purchase bonds from the commercial banks and sort of pump more money into the commercial banks. And since the commercial banks have more money that they can lend out, they would decrease their interest rates, which would, in that sense, make the uh, companies and people to be willing to lend more money. And that would basically put more money into circulation, which would stimulate growth and so on, right? That would increase the employment, and it would make the yeah different companies to invest more and just grow basically.
That's really cool. Yeah,
Yeah,
okay, okay. Now I learned something new. All right.
yeah. On the other hand, if they actually want to try to decrease the inflation, they would basically sell the commercial banks bonds, and that means that the commercial banks would have to buy these bonds from the Federal Reserve. So they would just pay the Federal Reserve money, and they would get those bonds, and that would get some money out of the system. And if there is less money in the system, the interest rates increase in the banks, which makes it sort of more expensive to rent money. And that's why some companies would sort of cease their growth because they don't have as much money to invest and to borrow and invest in projects. And that would also increase the unemployment instead. That would basically uh, lower the growth, the economical growth. So
All right.
does it make sense?
Y- Uh, it makes sense, but I'm not sure I could explain it back to you. But yeah, yeah. But okay, so but wait, so basically, so we have the central banks,
Yeah, put it
and
as a think as a pyramid. Okay, so put it the government up top, and then
yeah,
okay, maybe not up top, but yeah, think of it as it is up top, and then we have the Federal Reserve, the central bank,
yeah,
and then we have the smaller commercial banks,
yeah.
right? That lend money, yeah, between each other, and the federal bank is basically there. Yeah. the federal bank is higher than them, so to
The
speak.
big boss. Yeah.
Yeah, yeah, exactly. Yeah.
Right. So okay, so if you want to lower the interest rates, the central banks,
The central, yeah.
or no, the government is then selling bonds, no?
No, the government is not selling bonds. So
No?
what they would do is that the Federal Reserve would print money, and then they would buy bonds from the commercial banks.
Okay. Okay.
And since the Federal Reserve has printed money, they would be like, okay, here, take some money, and then we pump even more money into the system, and then we get back those bonds.
Right.
And now there is more money in the system, and since there is more money, the interest rates will decrease, right?
Yeah.
Because the banks would like to loan out that money.
Right. Since they have more of it, right?
Exactly.
Yeah. Okay.
And it's interesting, yeah, and the other way around, basically.
Yeah.
And it's interesting because I read somewhere that the banks are actually forced to have some kind of liquidity. Oh, I forgot the word. Liquidity. They should have like liquid assets.
Hmm.
And that liquid assets in this case and through regulation have been made so that it's mostly part or it's mostly like governmental bonds that are actually these liquid assets. And they are all, of course, uh, what would you call it? Of course, like a bank must, of course, have some liquid assets in the sense that if someone wants to withdraw their money, they would just, they just need to pay it back or at
Yeah.
least. Uh, but yeah, yeah.
Okay.
So yeah, and my whole point here is that I said that the banks are forced by the government to buy their bonds, and that was the whole thing that they are actually forced through regulation through have some to have some liquidity assets, and these assets are bonds, governmental bonds,
Hmm.
and all of these has have been actually made through different regulations and laws and so on, which is interesting.
Yeah.
Yeah, kind of a fun. It's like I force you through law to actually buy debt. Or maybe I'm thinking wrong. Okay, yeah. Okay, never mind. No, I'm just yeah, okay. Um
Right. Yeah.
yeah. So that was about the money supply and increasing, decreasing interest rates and inflation.
Yeah.
Uh,
Yeah.
I
That's
hope
interesting.
yeah, was it somewhat clear or was I completely
No. I think you were pretty clear. I'm
okay?
just I don't have the mental clarity at the moment. I feel like
Oh,
to truly grasp the details of the concept. Like I get the concept, but like yeah.
I think it's easier if you read it than
Yeah,
than listening to somebody explaining it. Yeah.
maybe. But yeah, I know that my mental sharpness isn't at the peak at the moment, so yeah, I will blame it on that. But
Uh,
whatever.
I mean, yeah.
Um,
Uh,
so yeah, do you have something more you want to say about bonds, or should we jump into the original topic, so to say? of this podcast, like how banks make money, because we haven't like talked
Yeah.
about bonds and stuff now, but
Yeah, that's good. Let's jump into how banks make money. I will if I have something to add, I'll just tell you.
yeah, and like also some of the things are a bit like a bit connected to the whole system as well. Um, so yeah, we might even go jump into some talking about bonds or whatever.
Yeah.
Uh, but so yeah, so just to simplify, uh, yeah, at the core, banks are considered lenders, right? That's like the main way they basically make money. I've written here, banks generally make money by borrowing money from depositors and compensating them with a certain interest rate. The banks will lend the money out to borrowers, charging the borrower a higher interest rate. It's a hard word. It's a hard word to pronounce, man.
Yeah. Borrower.
Borrower.
Yeah.
Charging the borrowers a higher interest rate and profiting off the interest rate spread. So basically, the interest that they pay uh, the depositors, the people who open the bank accounts and stuff, is much smaller than the interest rate they are asking their borrowers to pay them, right? So that is how they create the profit margin, so to say, to make money, and that's actually the number one way to make money. That's like the main way.
Interest rate. Yeah. And it makes sense because I think it's so easy to actually see the bank as somebody that is somewhat, or yeah, I don't know how easy it is, but I think some people may see the banks as fools, because they are actually just lending out money. Like, why would you lend out money just, but they are actually doing some great profits on that.
For sure, and like that has been like my biggest epiphany during this thing, like of learning about like how banks work, because I have always seen banks as, seen the banks in the wrong light, so to say. And then because it feels like we have, I don't know if programmed is the right word, but kind of led to believe, if you aren't like more interested into economics and stuff, that the banks provide you this service where you can park your money. There's just like a safe space for your money, but that isn't necessarily the case if you look deeper into it, since they first of all lend out your money and make more money from your money, and so and yeah,
Yeah.
so it's interesting.
Yeah. Yeah.
And I would assume that like it's uh also one of the reasons why it works, because most of the people aren't maybe aware of that, right?
Yeah.
It definitely like feels that way, since it feels like most people aren't like, I don't know, yeah, maybe I'm wrong, but it feels like most people like aren't really considering like thinking of that aspect of it.
Yeah. I mean, yeah. 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 I don't know what to add, but I think you're right. And there are so many parts in the whole economic system that you actually have to think of when, or so many parts. It depends on what kind of investment you want to do or what kind of thing you want to do with your money. But for example, when taking a loan, it's important to, think about, like, is this the correct time to actually take a loan? Because the interest rate may be like super high compared to what you may actually get it in a few years.
Hmm.
Of course, I mean, if you're forced to take a loan, then you must take a loan. Um, but it's just, for example, this last 2 years, the interest rates have been crazy. Um, so I mean, yeah,
Exactly. Yeah. Mm.
and of course, I
So
mean, if you break it down, banks. I mean, look how many banks there are all over the world. There are like the whole thing seems to work because there are so many of them. If it wouldn't have worked, then there wouldn't have been so many of them, right? So it all makes sense how I mean, they must be profitable somehow. So
yeah, yeah, for sure. And that is why I think the majority like isn't really considering that aspect of, and also that many people like aren't really introduced into other ways of like other uh vehicles, so to say, where you can like put your money. Like I think
yeah,
that the average individual like only knows the bank, especially if you aren't like at all into like I don't know stocks and investments and stuff, let alone investing in gold or something like that. The so it's I would dare to say that it is like a part of I don't know some sort of programming would be the conspiracy theorist uh in me saying that, but yeah, it's just the mostly advertised way of how you can I guess handle your money.
yeah, yeah, and I think that's the way. I think that's how most people see on. If I want to keep my money safe, where do I keep them?
Yeah,
That's not banks, of
yeah,
course. Yeah. So
that's crazy.
yeah,
Oof, oof, interesting. But yeah, so
that was the first
uh,
point, right? So interest rates.
yeah, yeah, yeah. Wait, oh, so yeah, basically this is about the interest rate spread. But however, banks need to manage credit risk, which is the potential of a borrower to default on their loans. So I guess that's the risk, and again, like yeah, there's almost like this I don't know double standard. Maybe isn't the right word to use, but they don't want to lend the money to bad
Lenders.
borrowers, and then yeah. Uh,
Yeah,
I
bad.
think yeah, like I think the banks lend the money, right? And
Yeah,
then
yeah, yeah. I
and the
was
one
wrong. I was yeah.
uh and also if you are a borrower with let's say a high credit score, or someone who the bank sees as a person who has a higher risk of not returning their money, or yeah, being able to deal with the debt, so to say, they will also increase the interest rates then, right?
Yeah.
If you are, yeah,
Yeah, I mean the better credit score you have, the better interest you will get on the loan.
yeah,
And yeah, I mean, I think the banks also have some kind of, you were talking about default and so on. I mean, if a person cannot pay back his or hers loan, then we just seize their whatever they use the money for. So
yeah,
if
yeah,
they have like a mortgage on a house, then they would just seize their house.
Yeah.
right? Or yeah, the same thing with cars and so on.
Yeah.
Um, but yeah, I think that the better credit score you have and the better you can actually show the bank that you, hey, I mean, if you have like if you a have like 100,000 invested in stocks and you go like, look, I mean, I want to take a bank loan for like 50,000 euros or dollars or whatever it is, but I have actually 100,000 worth of stock, then they would feel much more um, safe to actually do that or to actually borrow you money than than not owning anything and be like, yeah, I just want some money.
Right.
How can you back it up? Well,
Yeah.
and then we also have these that if you want to take a loan, for example, you could also have a, I don't know what this is in English. It's called when somebody can back you up.
Okay.
Um, uh, but so, for example, if you want to take a house loan, in
Yeah.
some cases they would require you to have somebody that could back you up. So if the bank doesn't consider that you could that they would get back their investment by selling your house in the case that you don't have the facilities to do that, they would just require you to actually have another person or persons to back your loan up.
Mm-hmm,
And
mm-hmm.
in that case, in case you won't be able to pay your loan, they will ask the other persons to pay it for you. And that's the crazy thing because I think there have been people, using that uh, method to just fool people.
Yeah.
I think that's another thing that one must be aware of.
Mm-hmm. Sure. All right. A quick pause. I will get my
Yeah.
charger.
So meanwhile, trying to find your chart or yeah, bringing your charger, I just look up the word and according to Investopedia or actually Investopedia, it's called to be a guarantor,
Okay, okay.
which is basically defined according to Investopedia as a person who guarantees to pay a borrower's debts if they default on a loan obligation.
Interesting. Okay.
So yeah, yeah,
Yeah, seems risky.
yeah. I mean, we had a teacher, and he, in some economic in high school, it was some kind of economic course, and he said that he would never do that, and
Hmm.
it makes sense. I mean, well, it's kind of a I don't know. It's a really tricky situation to be in.
Yeah, yeah, yeah,
So yeah.
for sure. Okay, 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 okay. So, before we jump into the second way banks make money, I have actually like this little title called "The Importance of Interest Rates." I will just see quickly if I have something. Uh, so right, right. So, it's like about like um, when we are like setting the interest rates. So in short term, the interest rate is set by central banks that regulate the level of interest rates to promote a healthy economy and control inflation, right? That is basically what you were saying earlier. But then in the long term, the interest rates are set by supply and demand pressures, which we haven't brought up. What do you think about that?
Well, you caught me completely off guard. So,
Tell me, Costin, everything you know.
yeah, so you said about the supply and demand,
Yeah.
the interest rates about the supply and demand.
Yeah, like in the long term, interest rates are set by supply and demand pressures, which I think was nicely put, and I think it makes sense because I guess the central bank or banks are the ones that are like kind of measuring or yeah, those pressures, I guess, in whatever forms they come. I guess they differ in like the different types of industries and whatever. Like I guess those um, supply and demand pressures, yeah, differ in that way. I think are different in the different types of industries.
Yeah, I think prices generally are a good maybe indicator of that. Right. So I think that the more demand there is for a certain product, the more expensive would it be,
Yeah.
and the less demand, the less expensive or the cheaper it would be.
Hmm.
Um, and where was I gonna go with this?
And maybe who is like setting the prices? No, I don't know.
No, I was just thinking that, looking at the inflation, I think the prices could be a good indicator of the inflation and like how the prices have increased over time and
Okay.
so on. Because
Okay. Because you.
no, because I was thinking that the more, we're talking about the money supply and so on.
Yeah.
And if the companies have more, or the people and the companies have more, money to actually buy and invest, that
Hmm.
means the demand will also be greater for, I don't know, all kind of products, which in turn will increase the prices.
Okay.
Um, and that would also, increase the inflation
Yeah.
and the other way around. So it kind of makes sense.
Hmm. Hmm. Yeah. Yeah, and like also, so when the interest rates are low, it's also like ideal for the banks as well, because uh, then it's the banks making like more money then because they can lend out more money, you know, since the interest rates are low.
Yeah. But it would benefit also when the interest rates are increasing because that means that especially the ones that have loans with a flexible interest rate or a interest rate that is not
Right.
fixed,
Yeah.
they will have to pay more in interest.
Right. Right. Right.
Um, so
Hmm. Hmm. Hmm.
yeah,
Hmm.
I mean the bank I'm currently using, they especially during the times where the interest rates were like keep where they kept like rising, I got like a notification every month that the interest rate for this accounts and these accounts or like for loans or and so on will increase like
Right.
so on and so on. So it was kind of crazy though to
Hmm.
see
Hmm.
how like every month um there would be some kind of increase.
Yeah, but like, isn't it the case that when the interest rates are high, that this profit margin with the interest rates like gets smaller when the interest rates are high.
What the profit
Big,
margin for the banks?
well, yeah, like yeah, like the because like now the first way that we were like talking about how banks make money is that they basically profit off of the interest rate margin between the interest rate that they pay to their what was the word again? Their depositors. Yeah, depositors, people who park their money in the banks, and between the interest rates that they ask of their borrowers who have borrowed money from the banks. The so
Yeah.
I'm guessing that margin would be higher if the interest rates are lower. Or no? I don't know.
Oh, I would argue the other way around. That's just because you have seen during these tough times how the banks have made profits
Yeah, no.
out of interest. It's just crazy.
Okay.
Um, yeah. I don't know.
Well,
To be honest, to be honest, I would think the other way around because they would increase the interest rates for the. I mean, if the interest goes up,
yeah.
then the borrowers would have to pay more in interest, right?
Hmm.
But I don't think the banks would increase the same amount for the interest for their depositors.
Yeah.
Do you follow?
Well, yeah, it makes sense, makes sense. Uh, but then again, if the interest rates are high, then they will get less lenders. But I don't know. Uh,
Yeah, but on the other hand, they would make up okay a lot of money, a lot of money from
yeah,
increasing the interest, those
that's
interests.
that's true, that's true.
Uh,
But if the rates are, flexible, wouldn't they come down as
when?
well? Like when the interest rates like just drop
Oh
or
yeah, of
like
course. Yeah,
sink a little, yeah.
yeah, yeah. Of course. I mean, they would. And I think that if you ever get a loan with a very, very small interest rate, like almost non-significant, then it's maybe better to even make it fixed if you have the chance or opportunity to do that.
For sure, yeah.
Um, but yeah, and then when it comes to flexible interest rates, or I don't know what they are actually called, variable, very anyway, flexible interest rates, then I think you have different options on how much it should vary. So for example, it could be
Right.
that every 6 months it changes,
Hmm.
or it changes every quarter or every year, or I don't know.
Hmm.
But that again, yeah, I'm not a banker that, so I'm not 100% sure either. But yeah, yeah,
All right. Then let's jump into the second way they make money then.
yeah,
Which is capital markets and income. Would you like to maybe yeah, summarize that?
yeah. I mean, this is also what we had discussed in another episode when we did or when we tried to figure out the stock market, right?
Yeah.
And all those uh, middle hands that help you as an investor actually help entities with your money or investing in entities. Um, and I think that's the same thing. Um, they are basically trying to connect investors with entities that need to raise capital.
Okay, but
Um,
how do they benefit off of that? Because I guess then the banks are like the middleman, right?
yeah, based on commissions.
Oh, okay,
Yeah, and then they have different fees and yeah.
right. A lot of
Mm.
ways to yeah.
Yeah, and then they also have, I think funds is also a very good point to include there. I mean, if they are managing funds, if they are actually actively managing funds,
Yeah.
I think the active funds are the interest rate is much, or the commission is much higher in actively managed funds than those that are actually more
Y-
passive, so to say.
Yeah, like index funds and stuff
Yeah.
and ETFs, right?
Uh, so that's what I would say.
Hmm. Hmm. Right.
Uh,
So
And then
yeah,
yeah,
yeah.
yeah, and then I've seen that some banks have their own funds. I mean, they are called by the bank's name. Uh, so that yeah.
Hmm.
So I would just say yeah.
I wonder if that is like also a bit sketch, so to say.
I mean,
Uh,
it is sketchy because if you, as a person that knows and that don't knows anything about, funds and
yeah,
so on,
yeah.
goes to the bank and say, hey, I want to invest some money uh, into the stock market. Of course, they would come up with some crazy ass stuff. Yeah, you know what? We have a fund that is
Hmm.
managed by us, by the bank.
Yeah.
And as you could see, you can trust us with your money because you have kept it here for I don't know how much. And we will be able to manage it.
And you always get it back.
Yeah. And so, look, if you invest in this fund managed by us with a commission of I don't know how many percent, um, in 2 years, this will be your yield. And in 20 years, if you keep investing, it will be this much. And in 50 years, you will be a freaking millionaire or whatever they can come up with.
Yeah, yeah, yeah.
It makes sense. It's a sales strategy, right?
Hmm. Hmm.
So, yeah. And that's the thing. They also offer, yeah, wealth management services
Exactly. Yeah, yeah,
that
yeah.
are connected to that capital market point.
But so under this capital market income, I have like three other like I don't know services, I guess. So banks facilitate capital markets activities with several services, such as sales and trading services. And I guess I don't know what sales entails, but the trading, I guess, is the managing of the right. What was the word? The
Stocks, funds, index funds, ETFs.
what? Yeah, like the opposite of. Thank you for all the options. But what's the opposite of mutual funds? There we go.
Mutual funds, I think.
Yeah.
Yeah.
So I guess the trading services are the mutual funds and stuff like that they manage, right?
I mean, stocks as well, I think. I think some banks allow you to buy stocks through their platform.
Right, right, right. Yeah. But sales, I don't know. Then we have underwriting services. I don't know what that is. Either. And then we have M&A advisory. Are you looking at the underwriting services?
Yeah, I was thinking about it under,
Yeah.
oh, is it like
Yeah,
underwriting
yeah.
services are provided by some large financial institutions such as banks, insurance companies, and investment houses, whereby they guarantee payment in case of damage or financial loss and accept the financial risk for liability arising from such guarantee.
So it's basically insurance.
Kind of, yeah.
Okay.
That's yeah, yeah. That's what I would say.
Right, right, right.
Yeah, insurance.
And can you look up M&A advisory? Like, M and just the end sign, then A advisory.
Um,
I don't know what that is, man.
Merger and acquisitions, I think. Yeah,
Okay.
our M&A advisory. Yeah, I think it stands for mergers and acquisitions. Uh,
Okay.
and is a broad term that describes the work that intermediates do in mergers and acquisitions. Most of this is concerned with advice to buy side and sell side companies on their merger and acquisition. But M&A advisors also conduct market research and help firms to raise capital for M&A. Yeah,
Okay.
so that would basically be advisory advisory services for raising capital, I would say.
Right, right, right.
Ish.
There we go. Yeah. Okay, cool. I guess maybe we will do like a more in-depth podcast in the future about
Yeah.
maybe those things as well. Uh, but yeah, meanwhile, maybe we should talk about the third way banks make money.
Yeah.
Yeah, which are fee-based income. So banks also charge non-interest fees for their services. For example, if a depositor opens a bank account, the bank may charge monthly account fees for keeping the account open. Banks also charge fees for various other services and products that they provide. Some examples are credit card fees, checking accounts, savings accounts, mutual fund revenue, investment management fees, and custodian fees. I don't know what custodian fees are.
That does custod what Google knows.
Huh?
Custodial fees refer to charges assessed by financial institutions for managing and safeguarding clients' assets. Yeah.
Wait, can you repeat that?
Yeah. Custodial, so it refers to charges assessed by financial institutions for managing and safeguarding clients' assets.
Okay, okay. Interesting. Okay. So it is like another form of advisory in a way, right? Or I don't know.
I think it's more about the retirement. Yeah, here I see retirement plan custodians. So I think it's also about like the retirement funds and so on,
Right.
the retirement accounts and or wait, what did you say?
When?
Just now.
No, I was just basically kind of concluding that the custodian fees are basically like another type of I don't know, consulting or I don't know, advisory
Yeah,
service-ish.
yeah. More like management and safeguarding advice. Yeah, I think it's a, I think you could define it in several ways.
Right, right.
Uh, but yeah,
Okay, okay,
yeah.
okay. And let's see.
That point. Oh, sorry.
Yeah. No, no, no. Go ahead.
No, I was just thinking about saying that, that point makes sense. I mean, yeah,
Which one?
that they are actually, charging for bank account fees and credit card fees and so on and so on.
And other minor, minor services that they are providing. So basically, every way they can,
Exactly.
there's a fee.
Yeah.
But
I mean,
it's a business.
exactly. Yeah.
But
Hmm.
okay, so here I have like an interesting sentence. So fee-based income sources are very attractive for banks since they are relatively stable over time and do not fluctuate. Uh, it is beneficial, especially during economic downturns where interest rates may be artificially low and capital markets activity slows down. Right, 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 right.
It makes sense. I mean, that's almost their fixed income, so to say.
Hmm.
Um,
Yeah.
yeah, that would be those.
Yeah, yeah, yeah.
Yeah.
Cool, cool. Like interesting. Like before this podcast, I was I don't know, hoping and thinking that maybe we could find some more mysterious ways banks make money. Like the more the conspiracy theory side of myself, theorist, the conspiracy theorist of me, I don't know, was hoping that we would like find some more interesting ways, but yeah, it was still eye-opening, like and good to learn about and know. But I guess there are like other schemes that banks and governments are involved in that also make them big bucks. So, yeah, interesting.
Yeah, and I mean, there are also this talk about that money that they make money out of thin air. Um, and for this podcast, it was interesting because I saw a video of a video. He was actually a professor from some university. He was a professor in economics anyway, and he wanted to do his research on how is this like, how do they actually. Okay, maybe I started from the wrong end actually, because they say that they make money. Okay, so some people say that banks make money by borrowing your money.
Hmm.
So
By lending out your money.
yeah, exactly, lending out your money. So if you have $1,000 and you deposit it in the bank,
Yeah.
they are in the US they are forced by law to keep 10% out of that sum as like in the bank as a security, or not as a security, but just to keep it in the bank as a sort of liquid
Yeah.
form. Yeah, and then that means that the 90% could be borrowed to somebody else.
Right.
And so those $900 would be borrowed to somebody else, and that person would go to another bank and deposit it there, and that would and they would keep 10% from from those 900, and so on and so on, and that's how they would make a lot of money.
Hmm. Hmm.
Because if you have as a depositor says that, say that, I have $1,000 in the bank, and then the lender said, yeah, you know what, I have actually $900. That means that from those 1,000 they have made 1,900. And I think that that's called the multiplier. One second.
Multiplier.
Yeah, the money multiplier. Yeah, I think, yeah, that's the money. That one is called the money multiplier. So that's what I think you follow the sort of pattern.
Yeah. Yeah.
And then there was this professor, and he wanted to like research, like, is this actually real? And he went to the bank, he took a loan for approximately $200,000, and he wanted to see where the money comes from.
Hmm.
And he noticed that they are actually not coming from any deposit account, but they are just in his account, just
Mm.
from nowhere, if you want to claim that way. And yeah, he made some research on that, and how the bank would actually show that on their balance sheet, and so on. And yeah, it was a short clip, but it had so many important points in it.
Hmm. Hmm.
But it was interesting. It was actually, yeah, it was an interesting sort of study.
Hmm. Hmm.
Um, so yeah, I think that's the way banks actually make money is a bit more complicated than we just explained. That's what I think, at least, and I think they have multiple ways of making money. Uh, So yeah,
Wait, so more complicated. What do you think? Like, what do you mean by that? Like,
I think, and especially in today's world when everything is so digital, um, we usually think on about money as something like cash. But I think in some cases, there was another one. There was I saw an interview with a person that he was like he had millions in the bank, and he went to the bank and he was like, yeah, you know what, I want to withdraw all of the money.
mhm,
And during a certain amount of time, they could just get like just a few, just a small part of it. So they
right,
didn't actually have the money to pay out to that person,
right,
even though his bank account said that, yeah, you have this balance,
yeah.
but it's more like a number than what is actually than
Showing how
what
much you have deposited it, like in the bank, right?
yeah, it's more like a number in a system than a physical thing,
Yeah,
so to
yeah,
say.
yeah. Hmm.
So it's something more abstract in some cases.
Well, yeah, it's like a. I don't know if we just look at like money is value, like supposed to like represent some sort of value. It's just yeah, kind of showing you ish how much value you have. I don't know, like in the bank, like yeah, ish. I don't know.
Yeah. Yeah, no. So I think the whole mechanism is a bit more advanced and complicated than what we sort of made it look like, because it includes so many different moments and details that we may not have included in this 1 hour and 10 minutes maybe.
Right, right,
Uh,
right, right, right.
so yeah, but I
But
think I would say that we got a good overview of it, right?
yeah,
Um,
because like for sure there are much more details into every
step.
step or points that we brought up in today's episode. But yeah, I think it's a good basic representation of like the areas in which banks are able to profit or get profit from.
Yeah, I agree. Yeah.
All right, guys. Hey, thank you so much for listening to this episode. Hope you learned something about the banks, about interest rates, about treasury bonds, about how to manage money, I guess. And yeah, we hope that this information will help you navigate life's spin.
Exactly. And if you have any comments about banks' interest rates, as Emil said, don't hesitate to write in the comment section. And yeah, don't forget to click the subscribe button so that we could follow our journey.
Yeah,
And
and grow smarter together.
that too. So yeah, with that being said, until next
Until
time,
next time.
adios.